Joining me now is Jason Horn from Steyn Capital Management to share his analysis on the day's market performance. Jason, thanks so much for your time this afternoon. Now, all eyes are on oil, right? With prices surging after the Trump administration slapped Russia's biggest oil firms with sanctions, of course, citing lack of interest when it comes to ending the war in Ukraine. What's your reading of this in terms of the demand and supply dynamics? How do these sanctions affect, I guess, the firm's ability to deliver oil to the market? And how much of a concern is this, considering that we are already in a market that's facing concerns of oversupply?
Thank you for having me. So I think if we think of the oil market more broadly, kind of looking at global demand is in and around 105 million barrels per day. Looking at what OPEC has been doing over the last 6 months as they continue to ramp up supply in order to maintain market share. Now, the significance of Russian oil being sanctioned is that you've still had China and India being large buyers of Russian crude, meaning that you have about 7 million barrels a day that's still on the market. Well, what's going on in Ukraine and Russia, where Ukraine has been attacking Russian infrastructure from a refining perspective, which is a very localized impact on the Russian cost of petrol, as an example. However, Russian oil is still getting onto the market more broadly. So what's effectively happened is once you put these sanctions on the Russian oil, this is kind of that first step that Trump is looking to with having additional sanctions on companies that will be purchasing this oil. So this has officially come into play. Historically, we've had the oil price cap, which has now been put away, and now these sanctions have come on, which probably means that there is going to be more pressure on the likes of India and China in terms of when they're looking at these trade deals with the US as well. In terms of, look, you guys need to actually stop buying oil now. And I mean, there have been some reports out of India from senior refinery managers saying that they effectively they cannot buy any oil now from Russia. So that's why you are seeing this spike in the oil price. Up about, I think it's about 6% today so far. So that is in the short term, but I think more broadly, it's kind of, we need to look at what the global growth dynamics are going forward. So do we see ourselves in a world in, say, 12 to 18 months' time where we're going to get this pickup in growth as there's more trade certainty, more deals made between the likes of China and the US and India? Probably, but in the short to medium term, with all this uncertainty that we are seeing in the markets right now, what is China's 5-year plan going to look like? That's being released now as we speak. So that's why you have seen this broad bearish sentiment around oil markets, obviously, until the sanctions came in today.
And sticking with, commodities, Sasol out with an update today, making good on its turnaround strategy. The last time I checked, that share price was up over 10%. Now, Jason, how much of this is on the back of the surge in oil prices versus, I guess, the reaction to that update that's out today?
I think it's a bit of both. To tell you the truth, I mean, looking at the update itself, it does read well, and it's in line with the expectations regarding volumes. But yeah, they have reconfirmed guidance across the board, which, given Sasol's track record on meeting guidance, is a positive. And then I think you've had broad strength across multiple divisions, kind of thinking on synfuels as well as coal production. And then also what's really positive is on the chemical performance, how they've been able to push volumes to offset these weaker basket prices. So yeah, they're making good progress on the financial targets. But yeah, look, it does help when your break even for oil is $55 to $60 a barrel, and all of a sudden it's up a good 6-7%.
And another company that's made good on its word is Afrimat. I'm sure people that betted against this one are kicking themselves right now. HEPS coming in 92% higher, of course, benefiting from higher iron ore sales. Let's just get your reading on those numbers and how it's turned around Lafarge, right? Now, this was an acquisition that did spook many investors.
Yeah, absolutely. Of course, quite a tall task when they came in for that deal. Look, I mean, looking at the results, I think the market's always going to be excited when the dividend doubles. So yeah, I mean the results were pretty well guided for and coming off a low base. But yeah, to your point on the Lafarge acquisition, the turnaround is well on track, and they did actually note that they are seeing the outlook is going to be actually even more positive post the reporting period. So it does seem like they are well on their way to getting that Lafarge turnaround and actually adding to profits.
Let's move over to Clicks then, Jason. Its store expansion plan to capture even more market share seems to still be bearing fruit, resulting in a 14% jump in earnings. What I found interesting is the growth in private label and exclusive brands, also speaking to the cash-conscious consumer, right? That's somewhat shopping down and looking for deals in the market.
Absolutely, and just to note, it makes up about 20% of their revenue overall now. So, yeah, it does seem that, I mean, we've spoken before about the consumer being under pressure, but this does speak to the defensive nature of Clicks. Strong growth, 10% in private label and exclusive brands, and that is very good for them. But look, retail is a tough place to be in. I mean, we have seen the likes of TFG earlier in the week. But yeah, I mean, they do believe they are well positioned in the environment going forward, given, like I said, the defensive nature of the sector they are in. But yeah, they're doing really well. I mean, the results overall are pretty much in line with consensus. So yeah, looking at it cold, it is very good. But relative to market expectations, it does have a pretty punchy multiple. So that's kind of why you're seeing a flat response to the results. But all in all, pretty good. And again, another SA retailer kind of hoping that that the SA macro environment does improve versus deteriorate going forward.
And I think what we've seen from these retailers, some of these numbers, especially that of TFG, is just how much pressure the consumer is under, and that the consumer is really spending their money on necessities. All right, let's just hit pause on the conversation at the moment. Before we move on to your stock pick, let's take a moment to touch on which counters your industry peers are watching closely.
So when you look at Airbus, the demand, and you can use Boeing as well, I prefer Airbus. I think the demand for aircraft, there's only a Boeing and there's only Airbus. I think that demand is going to continue for new aircraft for a long time. The only downside is supply chain. In other words, access to engines and getting those things. But I mean, the demand is there. The order book is incredible. You want a new aeroplane, I think you've got to wait like 5 to 10 years, for new aeroplanes. So I like, and they're also in a bit of defense. Yeah. I haven't thought of aviation now. We've been so obsessed with AI.
Be careful with this call, but I mean, when you look at Sasol, I mean, the same thesis that I mentioned earlier this year still applies. I mean, we've seen the company go up to close to 130 Rand levels month or so ago. It's now again trading at close to a 30% discount to its 5-year average P. Such a cheap company currently. When you look at the consensus, Bloomberg consensus is currently seeing it around about 75% higher, and this recent pullback is making it attractive for me. So this is more let's call it a trade, because I'm still invested in Sasol. But I think if you haven't acquired your Sasols yet, I think these 90 Rand levels that it's now pulled back to is making it attractive again to buy into.
You know what I love? I find it so fascinating that analysts always have a caveat when it comes to Sasol. It's like, be careful, you can go in, but just be careful. It really is one for a more riskier investor. But let's zoom in on Airbus, another defensive counter. What's your analysis on that stock in particular?
Yeah, it is an interesting one. It's not one that is on our radar. But I mean, David's argument is spot on. It's a dominant player, large order book, and they just announced this morning that they are getting into satellites as well to take on SpaceX. So that's going to be quite interesting. And then, yeah, look, I mean, overall, airline travel, revenge travel does appear to be over. But overall, growth in the space is continuing. I was listening to a podcast the other day with the Dubai Airport CEO. They've just hit 95 million visitors in a year. They're busy building a new airport by 2032, I think it is, to hit 200 million passengers a year. So in terms of the overall space, it's not slowing down. So yeah, very, very interesting one.
All right, let's get into your stock pick where you are seeing opportunity at the moment.
Yeah, the stock pick is my Pop Mart short.
Okay.
This is the Chinese
Labubu
market, yeah. Look, I mean, it's been trading at around 50 times PE, and they recently, earlier in the week, reported results that were strong as expected, but it's essentially just reflected the peak of the fad. So the markets were pricing in continued growth on these strong numbers, but we think that's unlikely, and 2026 is going to look a lot worse. And I think the market is actually starting to digest this. So the stock price is down 10% today, but yeah, interest in Labubu and their products peaked in July, and it has been declining sharply. So social media mentions searches are below 50% the July peak, and more importantly, the secondary market prices have been cratering in the last 2 weeks or so. So yeah, definitely one to look out for.
All right, let's leave it there. Jason, thanks so much for your time and taking us through trade at midday. That was Jason Horn from Steyn Capital Management.